The housing market is on the verge of beginning a major downtrend as homebuyers are scrambling to cope with rising mortgage rates. In today's video, we're going to look at the timing of when a housing market crash could happen and by how much. Let's get into it. Home prices have continued to set record highs each month despite reaching record levels of unaffordability. And although we are not currently in a crash, as many YouTubers would make you think based on their thumbnails and titles, there are some cracks showing at the national level that points towards a broader downtrend not being far off. If you're new to this channel, my name is Eric and I'm a professional private sector economist in addition to being a licensed real estate agent, which allows me to bring you a comprehensive outlook on the housing market you'll be hard pressed to find on other channels. Today's video is a continuation on my tracking of the housing market, when it could crash, by how much, and how is that changing as we get closer? What I like to do in these monthly market crash update videos is to give you the high-level summary up front, because a lot of you aren't going to want to stick around for the whole video, and that's fine. I'm here to give you the information you wanted when you clicked on the video. If you want to go through the deep dive of the latest data, be sure to stick around to the end of the video, and that's where we're going to cover everything. At this time, I'm going to throw in my usual disclaimer that this video is not investing advice, and although I am a licensed real estate agent, I am not your agent, and you are responsible for your own investing decisions. All right, now that that's out of the way, here's where things stand on my outlook. The Federal Reserve has made clear they're going to continue raising interest rates to get inflation under control. And they keep upping the ante at each meeting, which is what they need to do if they really want to bring inflation down. This matters for the housing market because as interest rates go up, so do mortgage rates. And as mortgage rates climb, homes become more unaffordable at current prices. Right now, the most likely scenario is that the Federal Reserve will hike their Fed funds rate by 75 basis points at the remaining 4 meetings this year. And if that were to occur, I estimate mortgage rates would reach 6.7% by the end of the year. This would push the monthly payment for a home purchase to such unaffordable levels that prices would decline by an estimated 20% by the end of the year just to bring monthly payments back to a more historical upper bound of affordability. Now that sounds like a big correction, and it is, but it's short of what I would call a full-blown crash in the housing market. In the last housing crash back in 2008 and 2009, home prices fell 30% from peak to trough, and that is the historical precedent I use for determining what a housing crash looks like. So this is the current baseline scenario I'm working off of right now. I have a few other scenarios I run the numbers for, one of which does point towards a full crash in home prices if the Fed gets as aggressive as they did back in the 1980s to fight inflation. So stick around until the end if you want to see where we stand on that scenario. But right now, there's a new development that honestly I didn't see coming, and it's changing the calculus here a bit. It's something that could push out the timeline for when we could see a beginning of a decline in average home prices at the national level. CNBC recently reported that there has been a surge in demand for adjustable rate mortgages, citing data from the Mortgage Bankers Association that showed that the adjustable rate mortgage share of total mortgage applications went above 10% in their latest survey. That is a noticeable jump from the 8.1% reported in their survey just 1 week prior. I went back through a lot of their prior press releases and noted this was the highest share for adjustable rate mortgages since May 11th when it hit 11%, and that was the highest it's been in several years. So we are definitely seeing a significant shift to adjustable rate mortgages as people are increasingly getting priced out of fixed rate mortgages. This is going to be an important new indicator on my radar when assessing the home price outlook going forward. I checked in with a lender in my area that I've done work with, and they're also seeing this shift towards adjustable rate mortgages for those who are comfortable with it. And being comfortable with it is an important part to it, because these can be riskier than a fixed rate mortgage. For a 5/1 adjustable rate mortgage, you get a fixed rate for 5 years and then an adjustable rate after that, depending on the terms of the loan. With mortgage rates much higher than in recent years, even for 5/1 adjustable rate mortgages, you would want to refinance or sell after 5 years, depending on what the interest rate environment is at that time. I'll get more into the risks of these loans and what the economic landscape could look like in 5 years in a separate video, so be on the lookout for that in the near future. If you're not subscribed to this channel, make sure you do that now and hit that notification bell down below so you know right away when that video comes out. All right, so now I'm going to look at what the adjustable rate mortgage does to my housing crash scenarios when I plug in that data. When I consider a housing crash scenario, I do it from an affordability standpoint. And right now, when I consider where the average fixed rate 30-year mortgage is at, as well as home prices and household income, I find that the average housing payment is at 38% of household income, surpassing the peak of 36% in the last housing crisis, and the highest it's been since the early 1980s. There's only so much higher it can go before homes are just so unaffordable that prices have to come down or transactions just don't take place. But here's the thing, when I substitute the fixed rate with the adjustable rate in my calculation, that share drops from 38% to 34%. That may not sound like much, but it puts us back a few months in terms of the affordability calculation. So I've created a new scenario, one that maintains the assumption that the Fed will raise their Fed funds rate by 75 basis points at each of the remaining 4 meetings this year, and this time looking at adjustable rate mortgages instead of fixed rate mortgages. Based on that Fed policy, I estimate the 5/1 adjustable rate mortgage could reach 5.5% by the end of the year. And with an interest rate like that, I estimate the median home price would have to fall by just 11.6% by the end of the year to keep homes in an affordable range. That's much different than the 20% decline by the end of the year when using the 30-year fixed rate mortgage in my calculations. Now, if you found this useful so far, please give this video a thumbs up to support the channel and help it grow. I do appreciate it. And I hope you will consider subscribing if you haven't already. I post videos throughout the month covering everything going on with the Federal Reserve, inflation, real estate supply and demand, and how all the latest data will affect the outlook for home prices. Right now, I'm going to go through all the underlying data from the last month. Some we don't get into too deeply, as I've been posting videos on those specifics along the way. So I'll provide links to those videos if you want to check them out. The major factor for the housing market right now is inflation. And you don't hear that very often. Before the last year, the two weren't really connected. But with the Federal Reserve trying to bring it down by raising interest rates, the two are now intimately connected. In my recent video on the latest inflation data, I highlighted how the consumer price index came in at 8.6% for May, a new multi-decade high, and showed that inflation has yet to reach a peak. In other words, it was exactly the kind of report the Federal Reserve did not want to see. At their latest open market committee meeting, the Federal Reserve increased their Fed funds rate by 75 basis points, something they had telegraphed in advance that they were not going to do. But just a few days before their meeting and after that hot consumer inflation report, media headlines started circulating that they were thinking of taking a more aggressive stance with the 75 basis point increase. And they've stated that they're prepared to do another 75 basis point increase at their next meeting on July 26th and 27th. But as much as it seemed like they were going to get serious about fighting inflation, they are still way behind the curve and may need to get much more aggressive in the near term if they want to bring it down. As I've shown in many videos before, the last time the Fed had to fight serious inflation, they had to raise their Fed funds rate 20% higher than the rate of inflation in order to bring it down. That was back in the 1980s. When we look at where the Fed funds rate is now compared to the rate of consumer inflation, we can see they would have to do a lot more. than 75 basis point increases at each meeting to get there. There are some that think the Fed is trying to bring down the stock market and basically scare people into not spending and hoping that would bring inflation down without having to raise interest rates so high. I covered this idea in a recent video, but it remains to be seen whether the Fed can pull off their infamous soft landing where they bring inflation down without completely crashing markets and the economy. Now let's switch gears a bit and look at the latest housing market data from Redfin, a national real estate brokerage. We have a new month's worth of data in, and it's starting to show some cracks in what has proved to be historically strong demand. The median home price in the U.S. has continued to defy expectations of a decline and set yet another record high in May, coming in at $419,000 on a seasonally adjusted basis. The fact that we've seen adjustable rate mortgages become more popular suggests that buyers are not able to bid down prices yet. And this is contributing to the new highs we're seeing each month. But as I mentioned before, we're starting to see some cracks in that strong demand. The sale to list price ratio took its biggest 1 month drop since Redfin began collecting data on it in 2012. And while it is still above 100%, meaning homes are selling above list price on average, if we see a confirmed downtrend in this metric in the next few months, we will most certainly see price declines on the horizon. And this wasn't the only crack in housing demand in the latest data. The percentage of active listings with a price drop shot up to 12%, the highest it's been since May 2020. And all this as the total number of transactions continues to decline. Home sales have continued their downtrend, but based on pending home sales, it doesn't look like we'll see the sharp downward trend continue next month, as pending sales have flattened out a bit. Given the totality of all the data, we appear to be on the verge of a major turn in the housing market. What I've tried to do is gauge how far prices could correct through the end of the year based on the scenarios I presented in today's video so far. The shallowest correction I've estimated so far was an 11.6% decline by the end of the year when plugging in the lower adjustable mortgage rate into my affordability model. And then there's my base case scenario that estimates a 20% decline by the end of the year when using the average 30-year fixed rate in my model. None of that amounts to a crash. Here's one that does. My worst case scenario, the one that assumes the Fed would get as aggressive as they did in the 1980s by raising the Fed funds rate 20% higher than the rate of inflation to bring it down, now projects a 30% decline in prices by November. 1 month sooner than my previous calculations. This is because inflation is at a new multi-decade record high, meaning the Fed would need to raise their Fed funds rate higher than previously estimated, and home prices keep rising along with mortgage rates and pushing unaffordability beyond historical upper limits. However, this scenario is becoming more implausible at this point because the Fed would have to raise their Fed funds rate by 225 basis points at each of their 4 remaining meetings this year. Now, I'm speculating at this point, but I just don't see them making that kind of a move unless inflation really starts accelerating beyond anything we've seen in the past. And the possibility of that is somewhat remote at this point. So that's what I have for you today. What do you think? Which scenario do you think is the most likely and why? Let me know in the comment section down below. And for my subscribers that have been regularly commenting, I just want to thank you sincerely. It's been a joy to read these comments, and I'm very glad that some of you are getting some real value out of the analysis in these videos. If you have suggestions of other aspects of the housing market you think we should cover here, let me know that in the comment section below as well. And if you've made it through to the end of this video, give yourself a pat on the back along with a thumbs up for the video. It was a long one today. Make sure you're subscribed, hit that notification bell down below, and share this with others on social media. I do have some shorter videos here and there as well that are a bit easier to get through, but I do like to do one comprehensive video like this one per month. Thanks for your support. I'll see you in the next video.